Hi, everyone, and welcome to this week's Energy Quick Take in 10. I am Jacob Ford. I am one of the investment specialists here at Tortoise Capital, and I'm happy to be joined by Rob Thummel, who is one of our senior PMs. So, Rob, first off, thank you very much for being here. I have a lot of conversation with advisors, and energy has obviously been kind of dominating those conversations and the headlines for that matter as well, because of what's going on in the Middle East. But the conversations have started to shift more to get back to more broader topics over the past, week or two. Advisors, geopolitics, it definitely still matters, but advisors, they want to know the bigger story. Talk about physical infrastructure that's required to power growth. Pipelines, LNG, grid investments, power generation, and how that all ties into data centers, nuclear, and just overall reliability. So I was hoping, we could just kind of chat about, some things that are going on, current events, and just, how this could be helpful to advisors, helpful to their clients, and, positioning energy as more of a long-term secular play, no longer just kind of a short-term tactical play.
No, yeah, absolutely. Well, I'm glad people are asking us about natural gas, right? I mean, oil's been relevant. We all know that. We've talked about oil day after day. It seems like it's still relevant. It's still important. But as you know, Jacob, we really like natural gas here at Tortoise. We like it for a lot of reasons. And what we're seeing is obviously the demand for natural gas is just going to rise, and it's going to rise pretty substantially over the next several years, and probably not just years, but decades, right? LNG is going to be part of that. AI is going to be part of that. And as a result, we're also seeing a lot more pipelines. You're going to have to see more pipelines that are going to have to be built to take natural gas from places like West Texas in the Permian Basin. In fact, there's not enough pipeline capacity today because some pipeline producers are having to take negative prices. There's negative prices actually in West Texas, which you say, well, how does that happen? It happens because there's no buyer on the end. There's no buyer of that natural gas because there's no way to transport it. Once these pipelines get built, there will be a buyer, and that natural gas demand will return, and we won't have these negative prices anymore. But when you have these negative prices, that's a clear indication of we need more pipelines. And so that's a great thing for us at Tortoise because we're investing in a lot of these companies that are actually building a lot of those pipelines.
Yeah, that's very timely because I think just very here recently, a couple of names, Diamondback and Continental, that announced that they're actually going to start, because these pipeline buildups, they're going to start increasing production, which is something I think we haven't seen for some time, right?
Yeah, well, I think the question is a lot of people have asked us is production actually going to increase in the U.S. or not, right? We've talked about it, capital discipline a lot. I know you've sent out a lot of great emails talking about capital discipline, and in this last quarter, a couple companies that are fairly large and they're large oil producers, Continental Resources and Diamondback Energy, both of them are in the Permian, one's in the Bakken as well, announced that they're actually going to grow their production volumes this year in response to the higher prices. So we are seeing a supply response to the higher price, the higher oil prices, and so that will help balance. Now you got to put this in perspective, though. We're talking about adding tens of thousands, maybe 100,000 barrels of oil to the supply. Remember, we're talking about millions of barrels, as much as 14 million barrels a day that have been of supply that have been offline at times for extended periods of time. So we've got a long ways to go on this oil in this oil market to get it balanced, but we'll get there.
Yeah. So we talked about all the natural gas that we're building, and now we've got increased oil production. I think that it's interesting to note that the U.S., the EIA, the Energy Information Association, just came out and said that last year the U.S. just broke a record for total energy production, and this is the fourth straight year that we've done this. Is this a record we're going to continue to keep breaking?
Oh yeah, I think it's a record that's going to be broken year after year after year, right? The U.S. is the largest oil and gas producer in the world, and we have record-setting production, and that record will be broken next year and then the following year. So yeah, I do think the U.S. is well positioned to continue to grow production year after year after year for decades to come.
Gotcha. Thanks. So one of the things where some of this natural gas is going, and a lot of people have talked about this and asked about it, it's going to these AI data centers. Whenever a hyperscaler is going to be like Amazon Web Services, Meta, Google. Whenever they enter into a contract with the data center, they're wanting what's called 5 nines reliability, which is they want those data centers running 99.999% of the time. And so that basically kind of boils down to natural gas being the leader in the clubhouse to help provide that reliability. And so, Cisco has actually come out with their quarterly call. They're talking about this hyperscaler demand and their AI infrastructure. You want to kind of touch on a little bit what Cisco was?
Well, have you seen, Jacob, how much we're going to really increase the terawatts, right? I mean, you've talked about that, and I think the EIA put something out about that this week too that you actually mentioned to me. I think it's something like 1.7% increase in electricity demand that you sent to me, and you said, put that in context, Rob, or I actually might even mention this. Think about that. That's like every year we're going to increase our electricity demand by about, I think that average out to about 75 terawatt hours a year. That doesn't mean anything to me. That probably doesn't mean anything to you. New York City is about 25 terawatt hours of electricity they consume a year. So think about that. Every year, if we increase just by 1.7% electricity demand in the U.S., that's like adding a New York City every 3 months, basically, if that makes sense, right?
Wow, yeah.
So we're adding a New York City every 3 months to the electricity grid. Hey, that needs a lot of electrification infrastructure, and it needs a lot of energy infrastructure in order to sustain that. And that's what it's going to take to win the global AI race.
Yeah. So yeah, you're right. On paper, 1.7%, annualized growth sounds like a drop in the bucket. But adding 3 New York cities worth of electricity, that's really, really impressive.
Yeah. Let me ask you another thing though. So Jacob, because we I know the guys out here, like you guys all like to talk about, sports betting is legal in Kansas and Missouri, by the way, and you guys all like to share your ideas, and now we've got Kalshi, right? And so we've all listened about these CapEx numbers coming out of AI. And so what do you think the Kalshi odds are that AI spending will reach $1 trillion by 2030?
Oh, I mean, they're probably pretty good odds. I don't think I'm going to win much money on taking that bet.
So are you going to take the over or the under on that?
I'll take the over.
You take the over on that?
Yeah.
Okay. How about $3 to $4 trillion? $3
to $4 trillion?
Maybe not by 2030, but let's say by 2035.
2035, I think I'd still take the over.
So you still take the over. Okay. Yeah. So if that happens, we're talking about double-digit growth, right? Double-digit growth in AI capital spending. Mm-hmm. And that's all coming to a lot of the companies we're investing in TCAI. And we've seen a lot of that. You mentioned Cisco. You mentioned Cisco earlier. That's exactly what Cisco's talking about. They're seeing a lot more capital spending, and a lot more capital spending being spent on network equipment, basically, to build out their networks. We're seeing it in memory and storage. We saw that in TCAI. We've had a great opportunity for companies like Micron, Western Digital, and these memory and storage companies grow revenue double digits, expand margins by double digits effectively, because there's an absolute increased demand for all of this infrastructure, basically, to build out these data centers, and we're benefiting from that, not only just on the energy side, but also at TCAI on the AI infrastructure side as well.
Yeah. Okay, so when you throw out huge numbers like $3 or $4 trillion over the next decade or so, one phrase I hear a lot from advisors is this is a bubble. And then you have Allbirds switching from making shoes to becoming an AI company. That doesn't really help the case. This is not a bubble, but this is not a bubble. This AI build-out is markedly different from the dotcom bubble that everyone remembers and experienced. What's the biggest difference between what we're seeing now with this AI build-out and the money that these companies are spending versus what we saw in the dotcom era?
Well, that's kind of simple. It's earnings. It's earnings, because we've got earnings. We've actually got earnings that are keeping up with the prices, right? So the price earnings ratios are not getting to be outlandish levels, right? We like to value a lot of our growth stocks, in particular in TCI, on a PEG ratio. And what I mean that is price earnings relative to their growth next year. And we're seeing a lot of the companies that we're investing in, the PE ratio, the current PE ratio is not giving the companies credit for the growth. And that's why we feel really confident about fundamentally these companies continue to be able to grow.
Right. Very good. That was all really good stuff. It has been a fascinating conversation. So I think for our audience, for advisors, the biggest takeaway is that energy, I think it deserves a broader conversation more often than it's actually been getting. Yes, oil, geopolitics still matter, but the bigger story is it's power demand, it's this infrastructure, it's the pipelines, it's the whole build out that we really need to support AI and electrification. For portfolios, that means energy can be more of a tactical commodity trade. It's got to be a strategic allocation because these physical systems, this is what's going to keep the economy running.
Couldn't agree with you much. And as everybody knows, there's no artificial intelligence without infrastructure, basically. And so we're excited about that going forward, and look forward to talking to everybody in the future.
Well, thank you, Rob. It was a fascinating conversation. And again, thanks everyone for checking us out.